Something wild just happened to Beyond Meat, a company most of Wall Street had already written off. Out of nowhere, the stock lit up like it hadn't in years, turning a forgotten ticker into the most watched name on retail screens. But just as momentum was building, the company dropped news that stopped everything in its tracks. Earnings delayed, an impairment charge coming, and questions about what's really happening inside. So today, we're breaking it all down. Why this delay matters, what's driving this roller coaster, and whether Beyond Meat is about to collapse under pressure or become the next meme stock resurrection story. Right now, the price tells you the whole story in a single glance. We are trading around the $1 area with a session range that shows just how fragile sentiment is while the market digests the latest update. This is not a namesake rally where price drifts slowly. It is a battleground where each headline creates a new line in the sand. And that is exactly what makes it interesting for traders and investors who understand catalysts and risk. Here is the spark that reset the calendar. Beyond Meat told the market it is pushing its third quarter results to November 11 after the close instead of November 4. Management said they need more time to finalize an expected non-cash impairment tied to certain long-lived assets. The company put that on the record, and multiple outlets confirmed the shift. When a date moves and the word impairment appears, short-term players react first and ask questions later, which is why the stock briefly dropped as much as the mid-teens in early trading after the announcement. This delay does not land in a vacuum. Less than 2 weeks ago, the stock exploded higher in one of the most dramatic squeezes of the year. Depending on the window you measured, the move printed roughly 240% in a week and about 600% in 3 trading days at the peak. That was not driven by a sudden transformation in plant-based meat fundamentals. It was a classic meme-style rush where extreme short interest meets retail appetite and a single headline or two tips the first domino. That context matters because meme mechanics can push price far beyond what a model would predict, and they can also reverse just as fast when the flow dries up. You might remember that the distribution headline added fuel when Walmart expansion chatter flashed across screens, which gave the rally an extra layer of plausibility even if it did not fix the balance sheet. That announcement came during the run and pulled in another wave of buyers who were not eager to let the first green candle be the last. In a crowded tape, recognizable brands with liquid options and high short interest are perfect candidates for rapid repricing, and that is exactly what played out in late October. Now step back and separate the show from the fundamentals, because that is where the call in your title lives. Analysts have been skeptical for good reason. Sales have been sliding for several years as consumer excitement cooled, competition increased, and the category fought against macro headwinds. The company has never posted an annual profit, and operating cash flow has been negative as management worked to right-size the business. Those are not opinions. There are facts that explain why this stock ended up in the basement before it became the latest short squeeze theater. So why did the delay punch the stock lower when the rally narrative was still warm? Because a non-cash impairment tells investors that assets on the books are worth less than previously assumed. And even if it does not drain cash today, it forces everyone to rethink earning power and return on invested capital. The market hates uncertainty and it hates calendar moves even more. When both arrive on the same morning, you get exactly the kind of gap and fade that flashed at the open. The only antidote is clear guidance on the call and numbers that show the core business is not getting worse. Until then, the burden of proof sits firmly on the company. There is a second reason the move stung. The rally that lit up social media and message boards gave some traders the feeling that a floor had formed. Then today reminded everyone that the meme bid can vanish when the story loses momentum. Headlines framed the surge as the next GameStop moment and even cited figures like 1300% in 4 days in some write-ups, which shows you how chaotic the data flow gets during a squeeze. In that kind of environment, you need verified numbers and you need a calendar you can trust. That is why the new reporting date matters and why we are drilling into it here. Let's see what is scheduled and what you can actually trade around. The investor relations site now lists the third quarter call for November 11 at 5 in the afternoon Eastern. That is your timestamp. Everything between now and that hour is positioning and psychology. Everything after that hour is math. If you are going to keep this on your screen, make that page your source of truth for timing and keep the noise in perspective. The price today tells you that the market is already adjusting positioning ahead of that event. Here is the open question that will hang over the chart until the call begins. How big is the impairment and what does it say about the assets and the path forward? A write-down can be a cleaning of the slate that resets expectations and frees management to focus on profitable lines. It can also signal deeper strain if the underlying demand is not there. The difference will be in the size, the categories affected, and the language in the explanation. When you hear that section of the call, pay attention to how management talks about utilization, shelf performance, and the outcome of pricing and promotion tests. That will tell you whether this is housekeeping or a warning. Price action is not random in the days leading up to a high-tension call. Watch how the stock behaves around round numbers and prior squeeze highs, and watch volume on green sessions compared with red ones. In a true accumulation, green days carry heavier volume and pullbacks happen on lighter trade. In a fade, you often see the opposite. If buyers step back in and defend a higher low, the meme crowd can find a second wind and try to press toward the next obvious level. If the bounce is weak and sellers control the close, expect patience to wear thin. None of this requires prediction. It requires observation and the willingness to act on what the tape shows you in real time. The other element you cannot ignore is short interest. When a float carries a high percentage of shares sold short, tiny sparks become bonfires. That is what we saw in late October when a fresh rush of retail orders collided with forced covering, and published estimates suggested short interest represented a very large share of the public float. When those positions begin to unwind, price dislocates, and if the borrow cost rises at the same time, the unwind accelerates. That does not make a business healthy. It makes a chart dangerous for anyone on the wrong side of the flow. Knowing that dynamic exists helps you avoid panic in both directions. Let us talk about the fundamentals that will either validate or puncture whatever the meme crowd tries to build. Before we continue, if you've been following this channel, you know I don't waste your time with hype or guesswork. I focus on research, real insights, and tools that can actually help investors. That's why I've partnered with The Motley Fool, one of the most trusted names in the investing world for over 20 years. You'll find my link in the description. It's the easiest way to check them out and see what they offer. That link also gives you access to special deals or discounts they have available right now. And yes, it helps support the channel too. Now let's get back to the video. Revenue trend is the first metric because it tells you whether the brand can still grow without discounting itself into the ground. Analysts were looking for something near the high 60s in millions for the quarter, and even that would reflect pressure compared with history. If the number misses materially and there is no convincing story about why, the price response can be unforgiving. If the company beats by a margin that cannot be explained by promotions alone, and if channel commentary shows traction, the reaction can be just as strong the other way. This is where the business has to speak for itself. The second metric is cash. A company can survive a lot as long as it has oxygen. And in this case, oxygen is cash runway, access to credit, and the ability to lower burn. Liquidity updates inside the release will matter more than the headline loss. If management details cost saves that are already in motion and points to a lower run rate for operating expenses, investors will give credit even if the quarter still shows red ink. If cash burn accelerates and the balance sheet looks tight, the market will price in the risk of future capital raises, and that is usually a ceiling for price until clarity returns. This is not a moral judgment. It is how risk capital behaves when capital is scarce. The third piece is guidance, formal or informal. Even if management declines to give a traditional guidance range, the tone and the forward-looking statements will convey a view. Listen for language around retailer relationships, food service traction, international demand, and category health. If you hear that sell-through is stabilizing and that promotion intensity is easing with elasticities that still work, that is constructive. If you hear that shelf resets are uncertain and that consumer fatigue is persisting across channels, prepare for a harsher reaction. Either way, it will answer the question of whether the rally was a short-term show or the beginning of a longer rebuild. I want to give you something concrete for timing because this is where people get chopped up. In names like this, the first move after earnings is often wrong for about 15 minutes as liquidity providers widen spreads and retail orders collide with headline readers. The second move comes when the call begins and the details hit. That is where you see whether institutions plan to buy the fear or sell the relief. If you are trading this live, let the first storm pass and focus on whether price can hold above the opening range once liquidity normalizes. If it can, you often get a continuation. If it cannot, momentum shifts against you and you wait for the next setup. The chart is a tool, not a prophecy, and in a meme charge name you respect that. A quick word on the big picture because this is a consumer brand at the end of the day. The category has gone through a sentiment cycle. It started with excitement, moved to saturation, and then met a set of macro forces that made shoppers rethink price and protein choices. At the same time, competitors tightened the field and private label got better. None of that dooms a brand forever. It means the next chapter requires sharper positioning, better cost control, and products that answer what real shoppers want now and not what investors wanted in 2019. If the call shows that kind of clarity and the impairment is framed as a reset rather than a retreat, the story can stabilize. If not, the market will keep treating every bounce as an exit ramp. Let us circle back to the title and answer it in simple terms. Is the surge real? Yes. The surge happened and it was powered by real flow and real covering. Is this the next meme stock? It has the ingredients that meme names share, which include high short interest, heavy options activity, viral headlines, and the price low enough that a few cents looks dramatic on a chart. Can it stick? That depends completely on what November 11 delivers. If the company quantifies the impairment cleanly, shows sales stabilization with credible color, and outlines a cash plan that lowers burn, the market can give it room and you can see a second leg that finally holds. If the numbers disappoint or the language is cautious and vague, the crowd that chased green candles will not be the ones providing a bid on the way down. Here is how I would watch it from this moment to the bell on the day. Check the investor relations page for any update to the time or access details so you are not trading off a screenshot from last week. Keep an eye on pre-market price action on the 11th because it will tell you where sentiment is before the facts arrive. Focus on the first hour after the release for direction, and then let the call confirm whether that direction has legs. Remember that a name trading at $1 and change does not need much absolute movement to print shocking percentage swings. A crowd can create that in minutes. The business has to justify it over quarters. Those are two very different clocks. I will leave you with one practical filter that can save you from the worst traps. When you hear a glowing claim or a terrifying doom post, ask yourself which line item on the upcoming release would have to change for that to be true. If the answer is revenue or gross margin, it is central and you care. If the answer is a non-operating line that does not affect cash, you mark it down but you do not let it steer your view. That simple question keeps you grounded when a meme name is trying to pull you into a whirlpool. This is it for this video guys, thanks for watching and please make sure to subscribe, like and leave a comment down below.